Hello, hello. So Atlassian was another company that crashed Friday. It went down 30% almost, as you'll see here. And its 1 year high has been $453, currently sitting at 123, down about 73%. A lot of these companies have completely tanked. And this is one of these companies that has been very, very overpriced for a while, and now it's getting down to its senses. Now, its earnings report wasn't terrible, yet again, some guidance issues are enough to pretty much destroy these companies in the current market. Now let's take a look at the earnings report that the company released, and after that we're going to be taking a look at the actual financials of the company, because when these companies are down that much, maybe, just maybe, they're a buy today. This is what we're going to examine. And Atlassian is a company that has a lot of interesting tools really that are being used by many companies, and so it is a company that is very, very interesting, and it's not easy to copy. So let's take a look at the earnings report. Now, they cut their full year guidance, and the article is actually wondering whether this is a sales signal. Let's take a little bit of a closer look. Contrary to the market's decisively negative reaction, which was down again 30%, headline numbers were looking good. So the revenue was 807 million, came in at the high end of the guidance pretty much. The company also gained about 6,500 customers during the quarter. The big issue was that they cut some of the guidance for the full year, and the market doesn't like that right now, of course, because we are entering a recessionary environment. It is to be expected, yet still the market doesn't like that, and they don't like holding the street, doesn't like holding companies that are not doing well, so they are the first to be dumped right now, especially when they are pretty much lowering their guidance. Now, the company, even though it's down more than 70%, which we talked about, it's still having even a price to sales ratio of 11. And in case you don't know what a price to sales ratio is, it's basically a ratio that tells you how expensive the company is compared to the revenue that they are making. Sales is the revenue pretty much. And so an 11 means that for a dollar that you invest, for $11 that you invest, you basically get $1 of revenue, is what this basically means. It's a pretty simple one, and it's very expensive. 11 is very, very expensive, and it's even more expensive if we're looking at a company that doesn't make money. Now, you'll see here that the previous valuation, at least that's what the article claims, was happening because of the impressive revenue growth and the strong investor confidence in the company. 31% year-over-year top-line growth last quarter, which is, of course, very, very high, as you can understand. But the shocking development in the first quarter, they trimmed their full-year revenue guidance, and it's something, again, that investors hate to see. Now, 3 months ago, management said the cloud revenue would grow 50%. Now they're expecting 40% to 45%. Again, something to kind of be expected because the economy is in shambles right now. And so, this kind of lower guidance is to be expected. But the problem is the reaction of the markets was actually really, really horrible here. Now, Atlassian stock is actually mentioned here as being overweight, and it used to be that, and today it was actually lowered to neutral. Now, overweight is a good thing. Neutral is actually worse than overweight, and so the price target was lowered by a whopping 48%. So that's a lot, actually. Imagine some analysts coming back and saying with a straight face, 3 months later, I'm like, okay, I'm gonna actually lower that to 48%. Imagine the reaction. Okay, so the article is telling you about how they are looking to basically face these issues, but what we do care about is whether it's a buy right now, whether this 30% decline could potentially be an interesting buy opportunity for the company. Now, of course, in order to decide, we need to take a look at the metrics, and the P ratio is coming at negative territory, and it's something that I hate to see. The company is losing money, and it's only after adjustments that their price to free cash flow is a positive number. We will examine that in more detail in the financial sheets because it's important. The outstanding shares, a little bit of dilution going on here. Not insane, but still, the company is diluting shareholders, as you'll see. And it doesn't have a lot of debt, and I'm assuming they have made quite some money from selling shares over here, from issuing shares. And their equity is going down, though, because they are probably not issuing as many shares as the money that they are losing, it looks like. The revenue is actually growing, net income is going down tremendously, and the free cash flow is going up because of the adjustments. I'm pretty sure that's a very usual thing to see. And The thing that I'm gonna be checking next is basically the financial statements. So let's take a little bit of a closer look here. Now, the revenue of the company is sitting at 600 million over here, and then growing to 2 billion. So they're growing at 35, 40, 38, 33, growing a lot pretty much every year. The thing is, after their net income is basically decided over here, you'll see that they are losing a lot of money. So they are in the red like every year, and very much in the red, frankly. It's only this year that went a little bit better, but then came back to what they were doing back in 2019. So not looking great. In terms of the balance sheet, now you will see here that the total liabilities of the company are sitting at 2.65 billion, and take a look at the additional paid in capital money coming in from pretty much shareholders, and total equity basically going down is what we examined earlier. They are just not issuing too many shares in order to make up for the losses that they're having, it looks like. So that's not looking good. They will probably have to either issue more shares or get some debt eventually, because there's no other way actually to fund themselves. There's just no other way. And you'll see here that it's only the adjustments, a lot of adjustments basically from other non-cash items here that take us to positive territory. And it's something that you don't like to see, because it begins with the negative net income. And capital expenditures are 33 million, and the company is starting to get starting to sell actually quite some investments over here compared to the purchases that they're making, starting to get rid of their investments over here. Interesting to see. And of course, as you'll see here, they are actually paying back some debt as well. Now, the free cash flow that they are generating over here is positive because of the adjustments. Again, what we talked about earlier, it's because of the adjustments here with the free cash flow. But the thing is, it's coming from negative net income, and it's something that we don't want to see, of course. And if we take it to our stock evaluation tool, it will tell us exactly what the company is worth after, pretty much evaluating for all this automatically. Kind of curious to see what is going on with institutional holders over here with the latest reports over here, and you will see that for the most part they have been adding a little bit. some institutions have been selling, but overall you will see that the aggregate data here tells us that the total ownership of the company is sitting at about 50% over here, which is about what was happening the past couple of years or so. So not much of a change here. It's actually they actually seem to be adding more than actually pretty much getting rid of a lot of stock over here, at least for the last reported date over here. Interesting to see, they don't seem to be dumping too much stock over here. And the other thing that I kind of want to take a little bit of a look at is the insider trades. And it's very, very interesting, because over here there is a lot of selling going on. Take a look at this one. This is basically selling and selling and selling and selling. It's everything selling over here, and it has pretty much been like that in the past 6 months. They are getting rid of a ton of shares over here, which is interesting to see. Like, the lots are not actually too many shares, as you'll see. It's like 1,800 out of like 300,000. But there is still a lot of selling and no buying, frankly, over here at all, or anything else. It's just plain selling here, as you'll see. Again, the lots though are very small. Like, the securities transacted are actually very small over here, so that's interesting. And of course, using our tool, you can kind of take a look at the exact filings over here, but just by clicking here, and this will actually redirect you to the exact document and the exact information over here from the EDGAR website, from the securities.government, and you will see here what exactly they have been selling, the amounts and everything pretty much laid out here. There's not so many compared to what they are having, as you'll see over here, but interesting to see. Okay, so the last thing that we're going to be doing, of course, is a stock evaluation tool. We're going to be examining how much to be paying for this company, if there is an amount to pay for this one. The revenue growth that we're going to be using is going to be high, 15, 20, and 25, of course, because the company is growing nicely. But the net income margins, again, the same story. Companies that is losing money, we have to go with marginal profitability, 1, 3, and 5%, something of that sort, just to get a sense of what the company is potentially worth if it starts making money. Now, the free cash flow margin, again, all over the place, because, it's only the adjustments that make it positive, frankly. And so we're going to go 80, 90, and 100%. Annual return of 13%, and let's see what is a price to potentially pay for this one. And as you'll see, it's way, way lower than what the current price is right now. And that's because the company is just not making enough money to sustain this kind of price that their stock has. And even though it's down 70%, it's still massively, massively overpriced for what it is. And it is a company that I would definitely not be adding to my portfolio. Even at this price, is very scary. Again, it would have to be substantially lower. It's super expensive for what it is, so I will avoid it. But do tell me what you think about Atlassian, and I'll see you in the next video. Remember to leave a like and subscribe, and again, see you soon. Bye bye.